So you piece all these things together. Does it start to paint a picture of a consumer starting to hit a wall of sorts when it comes to borrowing and spending? And should we be concerned when it comes to banks and financial firms and the markets, Guy?
I believe so. But I also think, well, I don't think, today was quarter end, month end, obviously,
Sure.
So maybe there's some rebalancing. So I want to make a huge deal out of it. But with that said, credit scores are now falling the fastest pace since the great financial crisis or the global, depending on what your G is for that, Dan.
I'm a global guy.
I'm a great guy. 90-day plus delinquency rates for credit cards north of 12%. That's the highest we've seen, I think, in 14 years. That's with, by the way, the average rate being about 21.5%, $1.2 trillion. So, yeah, there are a lot of, and I could rattle off a few more. There are a lot of reasons to be concerned about the consumer and all those things on the credit side, but it has not manifested itself in the market at all. HYG is hanging in there like a champ. And yes, today the banks were under pressure. Maybe it's a rebalancing thing, or maybe we're right to focus on it going forward.
Yeah, you know, it's the access to credit maybe is the thing when you think about a Klarna or you think about some of these other buy now, pay laters, obviously a firm. When you go to buy something on the internet, there's like 4 choices to extend those sorts of purchases. And I think that might be something unique to this cycle. The other thing I'd say about Klarna is, like, yeah, it had that first day pop after its IPO. It broke price within like a week and a half or so and has barely seen an uptick. So maybe investor demand a little bit is kind of something that we should have been thinking about because, you know, maybe this is just a one-day thing. Maybe it's a quarter-end thing. Maybe a lot of these kind of fintech and some of these other like alternative lenders have had a great quarter, you know, and we keep hearing about a resilient sort of consumer. Right. But, you know, this kind of push and pull between the Fed's dual mandate of kind of full employment and stable prices, they're kind of going at, you know, different directions now. And we had the PCE last week. It wasn't too hot. It wasn't cold. It wasn't anything. It was just still sticky. And then you think about this jobs number we're going to get on Friday. I mean, it may be the sort of thing where people are going to start focusing a bit more on this lower end consumer. Sure. And I think that's where this buy now, pay later really falls.
And I think the narrative has always been the consumer as a monolith has been strong. But if you take a look at the breakdown of the consumer, and this is the trend that we've been hearing, except that it was underscored last week when CarMax reported, and they said, you know what, our subprime customers, those with FICO scores under 550, they're having the most trouble. We're increasing loan loss reserves. We see that in the Tricolor bankruptcy, where a lot of their borrowers, did not have credit scores. Or if they had it, the average was something like 600. So they are also in the lower end. So this sort of highlights this sort of lower quality consumer. And when, if at all, should we be worried about that trickling up into sort of other effects?
Well, it's funny you said that because I love saying things aren't a monolith. The market's not a monolith. Consumers are not a monolith, right? That's why we see various ratings. And so we will start to get a sense 2 weeks from now when banks start to report. Those are going to be, I mean, JP Morgan, that's going to be a very different customer than what you're referring to
like
here, right?
CarMax or whatever,
right. Yeah. We'll see Capital One also. That will be informative. I do think that I am still long the banks. I don't love hearing data like this, but it has not shaken me from what I think is still an economy that is doing okay, that I think that the employment picture is still good. I think what could maybe rattle it a little if there is a shutdown for some short amount of time. But I feel like the higher end is still doing fine. And I think that will be reflected in the bank earnings.
Yeah. Mike, your thoughts?
Yeah, I mean, it's probably a little bit surprising to me. I would have thought that American Express would have held up better today on a relative basis. I mean, it's not that surprising, I guess. Capital One got hard hit. All those names you first mentioned, all of these things saw well above average put volume, and that's probably what we would expect to see. American Express, I actually would have thought, given that their demographic, skews higher, and I would have figured that meant that there was less of a spending capacity issue there, less of any kind of credit risk issue, that wouldn't be hard hit by expectations of cuts in consumer spending going into the holiday season, and yet it was hard hit. MasterCard and Visa actually held up pretty well. But I agree with Karen that I think JP Morgan and Capital One together are going to give us that tail because you do have those two very different customers at those two institutions.